Welcome, everyone. I'm Angelo Robles. I'm the host of the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Today's session, Advanced Digital Assets Investing. It features a very special guest, one of the most prominent people and successful in the community, and that would be Bart Stevens, co-founder and managing partner of Blockchain Capital. I've been a fan for a while. Bart, it's really a pleasure to have you on the show.
Angelo, I am thrilled to be here and looking forward to answering questions and interacting with some of your audience members.
Excellent. That sounds like a lot of fun to me. It's going to be hopefully a little, pardon the pun on the movie thing, but Fast and Furious. A line that I steal too much, but what a great title. Here we go. There are over 8,375 cryptocurrencies listed. Do we really need that many to exist? Obviously, the vast majority are quote unquote not going to make it. There's just so many. What do we do? How do we make decisions to invest?
Yeah, it's a great observation. You know, when my brother and I, who's my co-founder in Blockchain Capital, decided to found our venture firm over 8 years ago, one of the foundational observations we made was that at the time there was only one blockchain and one crypto asset, Bitcoin. And we did about 6 months of deep due diligence on not just the crypto asset known as Bitcoin, but the underlying enabling technology of the blockchain. And what we decided is that Bitcoin was super exciting. It was a kind of asset that was misunderstood and undiscovered. But the observation that really led us to found Blockchain Capital was this underlying enabling technology of the blockchain. You know, it proved that Bitcoin worked, and we saw a future where there would be thousands or tens of thousands or potentially millions of programmable digital assets. And it's why we wanted to start our firm, is to, you know, broaden the scope beyond just Bitcoin. And listen, Bitcoin's been very good to me personally, very good to our firm, but that is the tallest tree in the forest. We founded our firm to get family offices and foundations and endowments and ultra high net worth individuals along the whole forest. It would be like investing in, you know, a venture fund that did internet only in the mid 90s. And so to your question about, do we need 8,000 assets? Well, listen, do we need, tens of millions of web pages out there when most of us only maybe visit the top 100 websites? It's a debatable question. What I think is important to kind of understand is that these blockchain ecosystems allow for real-time innovation. We're crowdsourcing intellectual capital and financial capital at the same time from around the world, where the users of these networks are effectively the owners, and those owners become advocates. And what we see is people voting with their feet and voting with their pocketbook. And so, yes, there might be a long tail of 7,000 digital assets that no one's going to pay attention to, but there's literally tens of millions or hundreds of millions of websites that no one read, but that doesn't make Google or Amazon or Facebook any less valuable. And so when I look at, you know, the top 25 crypto assets, there's a lot of interesting things to do there in terms of doing research, comparing features and functionalities across blockchain ecosystems. And it's a tricky industry. It's why dedicated firms like ourselves exist, is to help institutional investors kind of separate the wheat from the chaff.
KYC, the Know Your Customer rules, and AML are the future of global crypto. What is the future of global crypto wallet regulation? It appears to be in the US relatively regulated, but globally it's still a little bit of the wild, wild west.
Angelo, that is a fair observation. And let me say that the regulatory landscape is one of the trickier things in investing in blockchain technology companies and crypto assets. At Blockchain Capital, we've been proactively reaching out to US and even international regulators since the founding of our firm. So I've given 2 talks at the New York Federal Reserve, 1 talk at the San Francisco Federal Reserve. I've met every single SEC commissioner. We've talked to the OCC, the DOJ, the CFTC, the Treasury Department, FinCEN, FINRA. That's just the whole alphabet kind of soup of regulators I just mentioned. There's approximately 9 regulators, not including the state-by-state money transmission licenses that US-based crypto firms have to grapple with. And I think what we've seen is, unfortunately, the US has lost their position in terms of fostering innovation here in the United States. The US Securities and Exchange Commission in particular, about 3 years ago after the ICO boom, sent out about 250 subpoenas to law firms, to entrepreneurs, to investment firms, to exchanges, to custodians. And that caused kind of uncertainty around the ICO process. And listen, there were good ICOs, there were bad ICOs. What became clear in our conversations with regulators and by subsequent actions by the SEC and other US-based regulators is that they didn't like financings that looked like traditional securities offerings before a blockchain was launched. A couple things happened after that kind of regulatory crackdown. Number one, we now see financings that are essentially in the form of debt, and tokens are not issued until the blockchain is live. That helps entrepreneurs and investors avoid a piece of kind of Supreme Court case law known as the Howey test that determines whether a given asset is a security or not, or you can even have a securities offering of a non-security. It gets kind of very complicated. But the practical impact of this regulatory uncertainty in the United States is that many of the entrepreneurs that are younger in this industry that didn't have strong ties to the US effectively went offshore. And so if you look at where are the global centers of excellence for blockchain technology, it happens to be in those jurisdictions where the regulatory landscape is more clear than here in the US. And so we see areas like Singapore or Switzerland have very clear regulations for both founders and for investors and for participants in this and these networks. Germany has a lot of crypto startups that are achieving a lot of financial traction. And we see Japan and South Korea actually have more clear regulations than the US. So the US has some catching up to do. The US regulators have kind of dual mandate. On one hand, they need to protect consumers from unscrupulous financial promoters, but they're also supposed to promote fair and efficient markets and foster innovation. And I would say that the US SEC in particular has focused too much on investor protection, less so on fair and efficient markets. We have notable gaps in the US regulatory landscape. For example, there's been no approved Bitcoin ETF. But on the other hand, if you look at Grayscale, they have $25 billion. And so they've inadvertently, or just due to kind of lack of clarity on their own part, king-made one company, Grayscale, that has a de facto monopoly. And so what we'd like to see is a more even-handed approach from US regulators that does protect investors from unscrupulous, securities offerings, but at the same time has a level playing field. So you're not making one company a de facto monopoly or favoring, say, the banking industry over the upstart fintech or crypto industry.
Yeah, very well said. Completely concur. One more question on that topic. A concern with people relative in crypto and going through exchanges, and you would think an advantage of some of the well-known exchanges we have here that are well capitalized and have great cybersecurity protocols is, will my data be protected? Now, we could argue, how about a government subpoena and the government gets your information and could kind of try to put together, quote unquote, your crypto history coupled in other ways. But even ignoring that, simply from the talented cyber hackers that are out there, we've seen problems happen before, admittingly more outside the US.
Yeah, that is a great point. In my conversations with the major portfolio companies, including the Coinbases of the world, and also a lot of the investors that have significant skin in the game, what we'd like to see, and Blockchain Capital wrote one of the 7,000 memos to the proposed midnight, FinCEN rule changes that Treasury Secretary Mnuchin tried to jam through at the 11th hour as he was leaving office, is we want to see just a fair and level playing field. So some of the proposed FinCEN is a department of the Treasury Department that looks after money laundering. And they basically proposed rules that would be more onerous than we see with, say, fiat paper-based cash. Things like disclosing transactions from a peer-to-peer of as little as $3,000. And if, Angelo, I were to send you $2,000 or $3,000 of Bitcoin, you would have to, disclose your physical address. That presents very unique to crypto security challenges where, these are bearer assets and you could put someone's physical well-being in harm's way for malicious actors like a thief or something like that. And so what we want to see is a fair and level playing field. So the crypto industry is already, David, fighting against Goliath of say the banking industry or the internet monopolies. We just want a fair playing field where we're not unduly hampered and we can kind of compete in the realm of innovation and capital. And so, the AML and KYC issues are important. And a lot of people that aren't as deep in the industry as you and your clients are, or certainly our firm, they think that crypto is unregulated and that, this is anonymous and it's used by drug dealers or terrorists or something. And the data just doesn't bear that out. An MIT study showed that it's like less than 0.14% of crypto transactions are used in illicit activity. And if you want to open up an account on the leading US-based crypto exchanges like Kraken or Coinbase, you're going to go through AML and KYC checks. And so what we could see if the regulatory uncertainty kind of persists is a bifurcation of the market where there's kind of regulated crypto exchanges where you can send crypto assets from one exchange to another, or kind of a whitelisted type program. And then there's this kind of crypto in the wild, which is not subject to AML and KYC type restrictions. And we do see some of that in DeFi, for example. And these two worlds will be have a kind of a reckoning at some point. And not to beat a dead horse here, but what we'd like to see is innovation with sensible, tailored regulation that understands that crypto assets are different than, say, stocks or bonds or currencies or commodities. And that also recognizes there's some unique benefits and challenges to taking securities laws that were written in 1933 and 1934 and try to apply them to next generation, natively mobile, natively digital crypto assets. And so the task of the regulator is significant. And what we like to see is close coordination between industry participants and lobbying groups like the Blockchain Association or Coin Center, both of which we're a part of, to have engaged conversations with regulators to just make sure that, David is already fighting Goliath here. Don't tie both of our hands behind our back.
No, I mean, innovation here in the US is really the key to success. It employs people, people have freedom and opportunity, and to overly regulate and potentially force people to go whatever, to Canada or a different country, it doesn't make any sense. There are some countries in Europe, several, that are worse than we're here in the US, and they're driving smart, talented professionals that generate income, a tax base, build companies, employ people, support communities. This is obviously, you can't take this cat, put it back in the bag now. It's too late.
I think you're right. In my conversations with regulators, and I spend, prior to COVID, more time in Washington, D.C. than I'd ideally like, I make that exact point to them. I say, number one, the enemy of capital formation is uncertainty. If you have founders, two dropouts from Stanford that don't know the rules of the road, they're going to take a guess. But they don't know if they're driving the crypto car 30 miles an hour or 100 miles an hour. And the SEC, with their lack of clarity in particular, has forced entrepreneurs, founders of companies, and investors like ourselves to make educated guesses. And then you have to kind of wait around to see if you have gotten some regulator upset as you looked at the tea leaves and maybe guessed wrong. And so, if we care about new jobs and growth and innovation, you need to have clear rules of the road for investors and for founders. And you're right, we are in a globally competitive industry. I started my career in 1997 working for the very first fintech company, which was E-Trade. We were charging $15 for a stock trade, and Merrill Lynch was charging $350. And we stole millions of customers from Merrill Lynch because better, faster, cheaper usually wins. And in the US internet industry, in the mid to late 90s, for the next 20 years, we more or less had the industry to ourselves. That's why we see such dominant market positions in Google, Apple, Facebook, and Amazon. These are straight up internet monopolies. But it was, probably those companies and the early predecessors, the Yahoos of the world, had about a 15 or 20-year head start on the Chinese internet giants of Alibaba and Tencent. That is not the case in crypto. These are globally deployed networks. Ethereum, Bitcoin, and other major crypto networks are global by default. We see centers of excellence in China, in South Korea, in Singapore, in Japan, in Europe. So it is really important for the US to be competitive here. and not just assume that like the internet 1.0 revolution, that all of the value is going to accrete to US based companies. That is simply not the case. We see it with kind of crypto juggernauts like Binance that primarily services the ex-US market.
We'll change directions a little bit. Will Ether market cap ever reach parity with Bitcoin?
You know, it's difficult to predict the prices of crypto assets. What I like to focus on is not the price of Bitcoin or the price of Ether, but real fundamental traction, on-chain economic activity. We at Blockchain Capital monitor a lot of things besides price. We look at GitHub repos, we look at social media followings, we look at community engagement from computer scientists, cryptographers, and experts in distributed systems. We look at general financial capital that maybe is outside of the crypto industry that might be tiptoeing in. My observation over the last 8 years in terms of the behavior of institutional investors, which in this cycle is driving crypto asset prices, unlike 2017, which was a retail-led market, is almost all investors arrive to the kind of blockchain technology ecosystem via Bitcoin. That is the gateway drug, so to speak, or the starter pack for most investors. And so I have a hard time seeing Bitcoin losing its market position. And I would argue that the Bitcoin and Ethereum blockchains are complementary. They do very different things. What we see in Bitcoin is that Bitcoin has, and the Bitcoin blockchain and kind of greater ecosystem is really turned into kind of this gold 2.0 narrative that you've talked about on prior shows, which is really, this is a store of value that is outside of the traditional financial system, that is inflation resistant, difficult for governments or companies to deplatform you or to seize your assets. And so I would argue that Bitcoin has already won the store of value use case of blockchain technology. When I look at Ethereum, I see something very different. I see a blockchain ecosystem that has more vectors of attack, but has much more functionality with smart contracts. And what we've seen is Ethereum has turned out to be the kind of financial services blockchain. We've seen absolutely parabolic growth in decentralized finance, also known as DeFi, and almost all of the DeFi activity is occurring on the Ethereum blockchain. And so if Bitcoin is kind of gold 2.0, I like to describe the Ethereum blockchain ecosystem as NASDAQ 2.0. NASDAQ has traditionally been where entrepreneurs and investors have gone to fund their business. Now, in the case of NASDAQ, that's large mutual funds and hedge funds that are financing technology companies. In the case of Ethereum, it's both institutional and retail investors, in addition to users of these networks that are involved in building on top of Ethereum. And we've seen that customer deposits in decentralized finance, or what we call TVL in DeFi, has grown from 3 to 30 billion in 2 years. It might be the fastest growing market segment of any industry anywhere on the planet currently. Absolutely astounding growth. And so what I would submit to you and your viewers today is that Ethereum is turning into the kind of financial services blockchain. And I think we could see other blockchains that kind of carve out a niche for themselves. So it's not one blockchain to rule the world, but we might have a store of value blockchain. I'd argue that that war is already won and it's Bitcoin. And in financial services, the jury's probably still a little bit out, but Ethereum has a really strong market position in financial services. We might see, we've seen that stablecoins have filled this gap for payments, and stablecoins tend to be multi-chain. They start on Ethereum. So if you see the rise of USDC or the launch of Libra, now called Diem, which will occur in the next 2 quarters, stablecoins have grown from $3 to $33 billion in terms of stablecoins outstanding. So really strong growth in Ethereum. The value accrual to Ethereum is a little in flux right now as it goes from Ethereum 1.0 to 2.0, and we're seeing a lot of value capture with DeFi projects. So kind of up the stack when you look at projects like Aave, or other kind of exciting DeFi protocols that, you know, look like financial services that are producing cash flow effectively. And these start to look more like kind of equity, tokenized equity positions to us. And there could be other blockchains that do things that are optimized for NFTs or for video games or for gambling. And so that's kind of our current view of the world, but it's important to acknowledge that this stuff moves really quickly. It's why we have a team of 10 investment professionals focused around the clock on it.
And Bart, are parachains making Polkadot the next Ethereum?
So for disclosure purposes, we're an investor in Bitcoin, we're an investor in Ethereum and a lot of Ethereum related projects. We are also an investor in Polkadot and the parent company, Parity. Parity has developed Polkadot, and parachains are an important part of that. What we see is the price of dots has gone parabolic recently. What we haven't seen yet, to be really transparent, is a lot of projects kind of start and get to scale on top of Polkadot. And Ethereum has been in the wild for a lot longer, or about 6 years now. Polkadot is brand new. Interestingly, Dr. Gavin Wood is one of the co-founders of both of those. And so, some might view Gavin Wood's Polkadot project as he took a lot of what he learned as the co-creator of Ethereum and has brought that over to the Polkadot ecosystem. We are really encouraged with what we see there from a technological point of view. What I think remains to be seen still, and it's just because it's so new, is do we see a bunch of DeFi projects decide that, hey, Polkadot is the answer for me, and I want to build on a parachain here. I think the early results look good, but it's probably too soon to tell. But it's certainly one of the most attractive projects from a layer one blockchain perspective that we've seen in many years. And there's a lot of developer activity. And so Polkadot is definitely one to watch.
Is Dfinity the future decentralized version of AWS?
I am always wary of crypto projects that like to compare themselves to centralized computational platforms. And I think that's true in Web3. That's true with Filecoin and storage. And Filecoin is a position of ours. Blockchain ecosystem, blockchains as a kind of technology or a network are really good at certain things, but there are some trade-offs. And, if you look at, transactions per second, for example, with Ethereum, it's not as good as Amazon Web Services, or even some of the blockchains that are optimized for transactions per second, like an Algorand or a Hashgraph or something like that. Dfinity has yet to launch. It's been very delayed. For disclosure purposes, it's not a big investment of ours. We have a small teeny position from the prior company. But what upstart blockchains like Dfinity, and maybe even you could put Polkadot in that category, have a challenge for is these blockchains have significant network effects. And so there's hundreds of thousands of developers that have already learned Solidity, the programming language for Ethereum. Are 100,000 computer scientists and experts in distributed systems going to be building on Dfinity? It's unclear. I know Ethereum has a huge incumbency advantage there. And all of crypto is fighting against kind of centralized web services that have massive incumbency. So when I see, crypto native people that are not just drinking the Kool-Aid, but chugging it and predicting that we're going to have a decentralized Twitter that dethrones Twitter, or there's going to be Web3 services, whether they're brought to you on XYZ, layer one blockchain, Dfinity, or something else, that are going to overthrow Facebook, or Amazon Web Services is going to have its market share dented by a decentralized approach. Those are really bold claims. Those need to be backed up with a commensurate amount of data. And I don't think, the data is there yet that decentralized services are in any way kind of chipping into the dominant market share of these effective internet monopolies. I think what we've seen in the popular press and what we've seen online with deplatforming or cancel culture, or even GameStop and Wall Street bets, is that these centralized platforms have real shortcomings. Basically, if you piss off someone that is in power, whether that is a billionaire like Ken Griffin or a political party on either side, you have a risk of having your platform taken away from you. And that's regardless of your political opinions or your technological approaches. And so there is perhaps a unique moment in time where all of us wake up and realize, wait a minute, I don't want to have critical web services and infrastructure taken away from me due to my opinions or the fact that I bought or shorted a given stock. And so, there's an interesting moment here where I think the value proposition for decentralized web or Web3, where the users own the network rather than a corporation that owns the network, is perhaps an interesting moment of time that could demonstrate to people outside of the crypto industry the value of decentralization. I don't think we're quite there yet, but some of these kind of straight out of the headline stories are starting to have internet users of these platforms ask real questions, which is, do I want, say, Mark Zuckerberg owning all of my data? Why am I not cut in on that? Facebook as a company has 2.8 billion people on Facebook, Instagram, and WhatsApp. That makes it larger than the population of China and India combined. It is more powerful than most countries on the planet. And Facebook is controlled. Those networks, those three networks I just described, are controlled by Facebook Inc. And Facebook Inc. is controlled by one guy in a hooded sweatshirt, Mark Zuckerberg. He controls the board, and he's made $120 billion of personal net worth off all of our pictures, our conversations, the articles we've shared, our likes, and none of us have participated in that. And I don't think that feels good to many people. And so in a next generation version of the web where things are decentralized and the users own these platforms, we might all be cut in on that incredible revenue stream that's associated with our own stuff. And I think that's a compelling vision. At the same time, we take a very sober approach to recognizing that these internet monopolies are giants, and the power of incumbency and the network effects in these are powerful.
Yes. Wow, that was very well said. You brought it up earlier. As a member, which I believe you are, of the Diem Association, what can you tell us about the future of Diem?
So I'm limited in what I can say due to non-disclosures about Diem, formerly known as Libra. What I can tell you is my views on what we've seen in the past. And what we saw in the past is Facebook came up with this idea championed by David Marcus, former CEO of PayPal, senior executive at PayPal, to do their own blockchain ecosystem that could be optimized for payments. And what we've seen in payments is that people don't spend Bitcoin for goods and services online. No one wants to be that kid in Florida that paid 10,000 Bitcoin for 2 cheese pizzas. You fast forward a decade later, that poor fellow spent $340 million on 2 cheese pizzas. And so
Help it was pizza.
Yeah. And so, what we see is that, as a result, the psychology is wrong. People want to spend depreciating assets, not appreciating assets for goods and services. And so the stable coins have really filled that niche because those are optimized for payments. And you look at Tether as the dominant one. Paxos has a great product. So does Circle and Coinbase working together for their USDC. But I would argue what we're going to see with Libra is the granddaddy of them all, because of those 2.8 billion people that I referenced earlier. But Facebook did something surprisingly self-aware. They recognized that they had PR problems. They recognized that a stablecoin wasn't going to be used if it was just Facebook coin. And so they decentralized themselves. They literally tried to do the right thing. They said, we're going to spin this out. We're going to give up 100% ownership, and we're going to be one of 25 owners. So Facebook owns just as much as Blockchain Capital, as Andreessen Horowitz, as Uber, Lyft, and Spotify. And so I would argue that Facebook tried to do the right thing by decentralizing it. Then they also went and talked to all the global regulators. What I think took the project by surprise is Congress. So Congress dragged the Facebook executives, including David Marcus, up, and they got mad at them for a series of things, including Russian election interference. And a 78-year-old senator's fax machine wasn't working. So that became David Marcus's problem. And that the web was unfair to conservatives or liberals. And long story short, the Libra project got overshadowed by the sins of prior perceived sins of Facebook. And so, and the many senators sent letters to PayPal, Visa, MasterCard, and Stripe, which were the kind of financial incumbent payment companies. And they effectively dropped out. The senator said, you guys have a government-sanctioned oligopoly, and if you mess around with this blockchain technology or this evil company, Facebook, we're going to take away that oligopoly. So number one, probably shouldn't have government-sanctioned oligopolies. Number two, they were getting mad at this decentralized project for centralized sins of the founding company. I would argue that's probably inappropriate. And so the Libra team went back and kind of rejiggered the project, and it is now launching not as a basket of global currencies, but pegged to the US dollar. So central bankers that are worried that a project like Diem could erode the sovereign power of a government or a central bank, those concerns should be put to bed or allayed at this point. And so what we should see in the coming 1 to 2 quarters, hopefully, is the launch of this blockchain ecosystem with the tacit backing of governments from around the world, where it is perceived not to be a threat to central bankers, because it's not. This isn't creating new money. These stable coins are backed one for one. When you deposit money in a bank, you could make the argument with fractional reserve banking, they're creating new money, right? There might, for every dollar in deposits, they might go lend out 10. This is not the case with stable coins. And so part of this is really just an educational process to global regulators to let them know this is just better payment technology. If you look at our incumbent payment technology, like the ACH system in the US for checking, or Fed Funds Wire, or SWIFT, these technology is based on 40-year-old IBM mainframe technology. Angela, I wrote myself a paper check 2 weeks ago from a Bank of America account to another one of my banking accounts. It's now 10 days later and my check hasn't cleared. This is writing a check to myself. So there's no AML or KYC issues. If I were to use a stable coin and say, send a stable coin from CoinList to Coinbase, 2 of our portfolio companies, that's going to settle in 6 minutes, way better than 10 days. And so the challenge on our industry is really to properly demystify this technology, convey to global regulators that Libra and other stablecoin technology is the natural evolution of better, faster, cheaper, more secure payment technologies. It's nothing more complex than that. So all of these concerns about sovereign power or Facebook are really beside the point. If we don't keep up with innovation, we're going to be leapfrogged by China in particular. If you look at the most sophisticated mobile payment market in the world, it is China, without a doubt, hands down, end of story, full stop, and we are losing the fintech war.
Ooh, how many dApps have been created on the energy web chain, and what are some of the use cases?
So the energy web chain is a portfolio position of ours, and this is kind of an optimized chain for the transmission of clean energy type credits. And so when I talked earlier about, and so off the top of my head, I don't know how many dApps are produced on top of the energy web chain, but it's a good example of kind of what I'll call purpose-built chains or kind of niche applications. So earlier in the interview, we talked about Bitcoin as Gold 2.0 store of value chain. We talked about Ethereum as financial services chain or DeFi chain. What I think we might see with Energy Web and some of the other projects that are in there is these are purpose built. In the case of Energy Web, they have probably 20 utilities that are customers. So they'll be able to kind of swap clean energy, quantums of clean energy with each other. And these are projects that are really in their pilot stage and eventually will be rolled out to more commercial stage. And we'll see if we can get buy-in from incumbents. Some of the challenges that I know you've experienced and I have in explaining crypto assets and blockchain technology to family offices and institutional investors is a big educational challenge. These are a lot of your clients in the participants in your network are super sophisticated family offices. They care and they're leaning in. They're saying, Angelo, help me understand this stuff. When you look at Shell Oil or some of these large participants in Energy Web or other similar type kind of consortiums, it's a big lift to get the traditional offline non-crypto native companies to understand the benefits of working on a decentralized platform that is maybe co-owned by your competitors too. What's weird about these ecosystems is there's a lot of co-opetition. You're cooperating with someone, but they're also your competitor. And so the challenge, whether it's in the energy market or supply chain and logistics, there's a challenge to get incumbents or offline traditional players to move onto a blockchain, touch a crypto asset, which they might be doing for the first time. And so it's important for necessary infrastructure to make it easy for those offline energy companies in this example. So, it's important for these projects to have a relationship with top tier custodians that understand these smaller cap crypto tokens. These are custodians like Anchorage or BitGo or Coinbase that are crypto native, have the engineering resources to be the financial infrastructure providers for these kind of industry specific blockchains.
When will security tokens like T0 become more widely adapted?
This is a great question. So we know a lot about security tokens. We invented the very first security token. So in April of 2017, early in the ICO mania, we had an interesting kind of dilemma at Blockchain Capital. Normally, we talk to founders and entrepreneurs, and we've met with over 5,000 founders in our 8 years,
Wow.
reviewed 5,000 projects. Sometimes it's just reading a business plan. Sometimes it's dozens of meetings. But the conversations that we were having at the seed stage with protocol developers, founders of companies, engineers, and computer scientists, usually, in 2013, 14, 15, 16 was, hey, Blockchain Capital, we want to talk to you about a project. Maybe you'll lead our seed round. But in 2017, those conversations changed. They turned into, hey, we want to do an ICO. And at the time, early in 2017, the US regulators, in particular, the Securities and Exchange Commission, really hadn't said anything. And so there was a lot of experimentation. There was good ICOs, bad ICOs, ugly ICOs, big ones, small ones, everything in between. And it caused us to take a pause, and we actually had a little corporate offsite. And we had to look at our business. We said, wait a minute, what's going on here? These are founders of crypto projects that want to use blockchain technology to finance their project or their business. They want to crowdsource capital. And so this is effectively blockchain technology, arguably disintermediating the role of venture capitalists. And that's our business. And so we had this existential problem. We said, well, if anyone's going to use blockchain technology to disrupt the venture capital industry, it should probably be blockchain capital. And so we decided to disrupt ourselves. And we wanted to raise our third fund as an ICO, but we wanted to do it in an SEC compliant way. And again, this was before the SEC came out and said anything about what they do and don't like about ICOs. And there's still a lot more they should say. They haven't. We already talked about that. And so what we did is hire two of the fanciest law firms we could think of, Simpson and Thatcher, and Skadden Arps. These are Goldman Sachs and Morgan Stanley's law firms for securities law firms. And we said, hey, we want to tokenize our third fund. So limited partners in our fund will not have a piece of paper, the offering documents, which is traditionally what you'd have in a venture capital fund. They would own a token. And that token will represent the net asset value of the fund. And so we decided to create the world's first security token. And we did it via a Reg D 506C offering, so only for accredited US investors. And internationally, we did a parallel Reg S offering. And so we basically assumed that ours was a security, and we created the world's first security token. We did it with a outstanding technology partner by the name of Securitize. We were so happy with our experience as Securitize's first customer, we went on to lead their A round, and my brother sits on the board there. But what we saw with the security tokens is it was a fantastic idea. Our BCAP token raised $10 million in less than 30 minutes, and we had $110 million of demand. We took that $10 million and we invested it in Coinbase, in Anchorage, in Bison Trails, in Filecoin, in some of the leading projects in our sector. And so that $10 million has been invested into all these great projects. The token is now worth close to $7. And our view of the world would be that these tokens, these security tokens, would trade on crypto exchanges. So investors could come and go and sell the token in the secondary market. However, the US Securities and Exchange Commission has blocked all of the crypto companies like Coinbase and others from having their broker dealers made effective. So Coinbase and other companies, Bittrex, Gemini, they've acquired broker dealers, and they're just waiting for the SEC and FINRA to make them effective. So what is hampering the security token market, in my view, is the US regulators haven't let traditional broker dealers, think Goldman Sachs, trade crypto, but they also haven't let Coinbase trade security tokens. And so the security token market is stuck where traditional broker dealers can't touch crypto. Crypto companies that own a broker dealer are not letting them the SEC and FINRA aren't letting them be made effective. And so the whole value of security tokens is to bring liquidity to historically illiquid assets, or to take offline assets like commercial paper or credit default swaps and put them on the blockchain. For all that to happen, we need more regulatory clarity. So we're right back to talking about the need for regulatory clarity here in the US. With all that said, I'm a big believer in security tokens. To me, it's an if, not a when, because what we know from blockchains is they're really good for title transfer, and that a lot of these offline traditional credit products are traded and settled using fax machines. You know, if you look at collateralized loan obligations or leverage loans, the trades are done over the telephone. And there's, you know, fax machines involved and hordes of people in the back office reconciling these manual paper-based processes. This stuff should all go to the blockchain, but we need regulatory clarity for that to happen to enable the secondary market trading of security tokens, which is the value proposition, I would argue.
Where is liquidity mining and yield farming headed?
So liquidity mining, yield farming, these are phenomenons over the last 6 months. And there's a lot of experimentation. And so we first saw it with Compound, and we've seen it emulated by others, including a lot of DeFi protocols that are, at the end of the day, if you want to boil all this behavior down, it's about bootstrapping a network and kind of providing financial incentives for people to get involved. Investors in Silicon Valley, where we're located, over the last 40 years have been very attracted to network-based businesses and marketplace-type businesses. eBay being probably the first internet-enabled marketplace business that grew to be an absolute massive company. Because it's really great to be a marketplace, to be the, you know, the venue where buyers and sellers meet and you get to take a little piece. Marketplaces benefit extremely by network effects, where liquidity begets more liquidity. And so the challenge in network-based businesses is, how do you jumpstart that liquidity? So in the case of eBay, well, they were first. That really helps, right? For people to sell their Beanie Babies, or in the original days, I believe it was like Pez dispensers. But once you build up that competitive mode of liquidity, it's kind of your game to lose. And so what we've seen with liquidity mining and yield farming and their various derivatives is this is a really clever growth hack to jumpstart liquidity at the earliest days of a project. And now these are kind of short-lived phenomenons. And so we've seen kind of yield optimization strategies where Yearn effectively crowdsources strategies and does that for investors. And I think what liquidity mining is really tapping into is the unmet need for yield in a yield-starved world. You know, due to the macroeconomic conditions and central bankers busy running, you know, their printing presses around the clock, we're going to see tens of trillions of dollars of monetary stimulus by the time COVID and associated, financial carnage is dealt with. And so that has pushed up the prices of bonds worldwide. We're arguably in a 40-year bond bubble, and it's depressed yield. But a lot of investors need a yield component in their portfolio. Think of insurance companies and pension plans and this sort of thing. And right now, if I'm running a pension plan, not only am I not getting yield by lending money to Germany, I'm paying for the privilege to do so. It's absolutely crazy. And so what we've seen is kind of yield farming is accomplishing two things. It's number one, bootstrapping these networks to jumpstart that liquidity effect, that where liquidity begets more liquidity. And number two, I know personally, I am looking for yield in my personal account. And so I have my stable coins on one of our portfolio companies' platforms, Abra, and they're lending those out to other financial participants. I make 10% on my US dollar cash. This has been upgraded. It's not fiat paper cash. It's in USDC, which is tokenized cash. But where in the world can you get 10% on your US dollars? Now, I'm taking counterparty risk. I'm taking a different counterparty risk than, you know, doing a bilateral trade with Deutsche Bank, whose balance sheet I don't trust, for the record. But these are different types of accounts. So I might have smart contract counterparty risk in the case of a DeFi protocol, or I might have counterparty risk on who Abra's counterparties are. But what we're seeing here is, in a yield-starved world, there's unmet demand, and crypto entrepreneurs and financial protocols are filling that. The rest of the credit markets haven't figured it out yet. This is still really hard to access. DeFi is deep in the weeds for most investors, even crypto investors.
Yes.
And if you talk about yield optimization strategies and moving from this liquidity mining to this yield farming, all of a sudden you start needing pretty sophisticated financial and crypto expertise that is going to vastly outstrip the average credit manager that might be at DoubleLine or Oaktree or one of these kind of credit type managers that manages trillions of dollars of capital. But it's an exciting area of product market fit. and it's a yield-starved world, and these DeFi protocols are filling that need. But we are in the earliest days here because it's really hard to use.
For sure. In my end of year wrap up to families on asset allocation percentage of their portfolio and fixed income, in my commentary, I boldly took the claim of, yeah, part of the fixed income should look at some of the things that you're talking about because the returns could be great. But yes, are they going to be more risky when you look at counterparty risk? They are. But for a percentage of the portfolio in a yield starved world, they could be incredible, again, with some caution. And even for those that are more active like us in the community, it hasn't gotten the wide adoption we would have thought, but I think it's coming. What are your views on, I just love to say it, non-fungible tokens, NFTs, and special tokens?
Yeah, so for the users that aren't familiar, or your viewers that aren't familiar with non-fungible tokens, most crypto assets or cryptocurrencies like Bitcoin are fungible, or Ether, right? Your Bitcoin is the same as my Bitcoin. They don't trade at a premium or discount relative to each other. And that fungibility is a really important part of what makes Bitcoin valuable. Non-fungible tokens are meant to be unique. And so a lot of the early days of NFT were really around looking at the intersection of kind of crypto and video games. I know that sounds strange, but the video game industry is the largest entertainment category in the world. In my prior 12-year career as a hedge fund manager, we invested in a bunch of great video game companies like Tencent the day it went public that created these online worlds. And these online worlds have virtual economies, and these economies have digital currencies. Those are, in my view, the predecessors to what we now call cryptocurrencies. But in these virtual worlds, like a World of Warcraft or a Fortnite, you might have some unique special object. And in the case of World of Warcraft, if you got a special object like a magical sword, what you didn't know is, was that one of 10,000 swords, or was it one of 10? If it was one of 10, it might be quite valuable. If it was one of 10,000, not as valuable. With blockchains, we can mathematically prove digital scarcity. And so a lot of the ideas around NFTs came from these notions of gamers, where you could have player-owned economies and you could pull that digital sword out of the video game and sell it on a marketplace like OpenSea, where we're an investor, for real world dollars or stable coins or Bitcoin. And so, we're an idea that effectively started in the video game industry. We're now seeing burgeon out into streamers, esports, certain digital artists. And what we see is that what we know is blockchains are really good for proving authenticity and tracking transfer of title and scarcity. Well, digital art or, certain even financial products can be non-fungible tokens. And so we're very bullish on non-fungible tokens. And we have a lot of investments in that area. We continue to do research, and I think we're going to see it with celebrities and their followers. You might be able to earn, if you're a super fan of Justin Bieber, you might get one of 100 certain, article of clothing that's a digital that you can, represent in a digital world, or maybe it's backstage pass to see him when concerts resume. But that itself could be traded. That's something that is of value. And so whether it's art or video games or financial products, non-fungible tokens are still in their infancy, but I think there's strong and compelling use cases. And we're going to see the growth of that industry continue for the coming years.
What do you think will be the biggest threats to Bitcoin?
So that is a great question. I think the threats to Bitcoin could come from regulation, where central bankers, perceive it as some sort of a threat. I think that is mitigated, at least here in the United States. I mean, Bitcoin and Ether are really the only two crypto assets that are in the clear from a regulatory point of view. So for example, the IRS has already come out and told crypto investors, you have to pay your taxes, and it's short-term and long-term capital gains, just like your house or your stock portfolio. They've also said that Bitcoin and to a lesser extent Ethereum are sufficiently decentralized so as not to be considered a security. And so I actually think, Bitcoin is already in a safe place, at least here in the US. Internationally, regulators kind of differ from country to country on how they see Bitcoin. Bitcoin is already the 16th largest currency if you want to look at that. Now, we already discussed, I think Bitcoin is more like a crypto commodity, like gold 2.0 rather than PayPal 2.0. But it's achieved significant scale. Its market cap, if you want to look at it as a company, which isn't exactly right, but it's close to $700 billion. That's about the same size as Facebook. And so I think Bitcoin is kind of in the clear. But what I think we're going to see over time is Bitcoin is going to take market share from gold. At Blockchain Capital, we went out and partnered with Harris Poll. Harris Poll is the #1 political polling agency in the United States. They went out and talked to 2,500 American households to take their kind of temperature on Bitcoin. And what we saw from these results, and you can find them on our website at blockchaincapital.com, we've done this 3 times with Harris Poll, is that younger people overwhelmingly like Bitcoin at the expense of gold. So gold is an $11 trillion market cap. It's going to shrink in market share. Bitcoin's going to gain in market share over the next 5, 10, 15, 20 years. And I think threats to Bitcoin are going to be pretty minimal compared to what we might see outside of Bitcoin, which is, we talked earlier about kind of Web3 or using blockchains as a decentralized platform where users own these social media platforms. We're going to see the web incumbents fight like hell against that. You know, the Facebooks and Amazons and Googles are notoriously quiet when it comes to blockchain technology and ideas and concepts around decentralization. If you're a centralized internet monopoly, you just be quiet and keep cashing the cash flow checks and, pay off your lobbyists to keep Congress at bay so they don't drag you up in front of hearings. And so, I think when we look at the rise of Web3, you're going to see significant fights from incumbents. When you look at some of the regulatory landscapes around financial services, I think we'll see the banking lobby start to fight hard against DeFi 5 years from now or 10 years from now when it's actually on their radar screen. We've even seen, Brian Brooks was the outgoing head of the Office of the Comptroller of the Currency, probably one of the major banking regulators in the US, with the FDIC and the Federal Reserve in that camp as well. And Brian Brooks said, hey, banks, it's okay for you to run a node. By the way, you can custody stablecoins. You've always been able to do this. And the OCC, this regulator, Brian Brooks, the former chief legal officer of Coinbase, so he's crypto friendly, got sued by state banks. And they said, whoa, we don't want to deal with this stuff. And so I think over time, we're going to see banks kind of dig in their lobbying efforts. They've already done it kind of informally and in the back rooms and with some whispering, but they haven't really seen any dent in their market share. When that comes from decentralized financial applications over the next 10 to 20 years, I think we will see more of a clash between, say, DeFi protocols and the crypto industry writ large with financial incumbents.
Now, here in the US, I guess the incoming, well, now she's a Senator, Cynthia Lummis of Wyoming, is incredibly favorable to the crypto community. And there's others, I'm not remembering their name, that self-custody Bitcoin. That's going to gain momentum and, again, help to cement crypto, Bitcoin, and hopefully the whole digital assets ecosystem and help protect it, we would hope, from regulatory concerns moving forward.
Yes, that is a really interesting observation. And Wyoming is kind of this shining regulatory city on the hill, if you will. Like we talked about earlier in the conversation, the US is in competition for intellectual capital and financial capital on a global basis.
For sure.
You could shrink that down into the United States and say states are in competition with one another, especially what we're seeing here in Silicon Valley is an absolute brain drain. You've got investors and entrepreneurs and founders that are fed up with San Francisco, the crime, the status of the city.
They're going to Utah, Texas, Wyoming.
They're going to Texas. They're going to Utah. They're going to Vegas. They're going to Miami. And so there's this incredible brain drain. So states are now competing for intellectual capital and financial capital. Miami wants to be a crypto center of excellence. I was on a private conversation with the mayor of Miami. He said, I'm particularly targeting the crypto industry because even within tech, these are the people that are pushing the edge of financial services,
yes,
pushing the edge of web services, and they care about things like governance. And so Wyoming has said, wait a minute, we want to be a center of excellence. We care about property rights here in Wyoming, and we want to have the type of Silicon Valley innovation that's driven California's economy for 40 years. We want that in Wyoming. And so there's a woman by the name of Caitlin Long, who is actually on our advisory board, who has single-handedly kind of gotten the state of Wyoming to make more crypto-friendly regulation. She has a startup called Dfinity, which is kind of a crypto bank that has a banking charter in the Washington. So does another one of our portfolio companies, Kraken. And so Wyoming is saying we're open for business. We want to foster innovation. We're not going to let this uncertainty at the federal level keep us from getting in on this emerging technology industry, blockchain technology. So Wyoming has got the right idea. I wish New York and California were doing some of the same things. But what we see from financial incumbents, or in this state, conversation, government incumbents, is California has gotten, I would argue, fat and lazy and entitled. They just assume that Silicon Valley innovation is always going to be, located in Silicon Valley, where in fact Silicon Valley is fragmenting. It's going to Austin, it's going to Utah, it's going to Colorado, it's going to Florida, and our local government officials are kind of asleep at the switch. I was in another conversation with Mayor London Breed, and all she could complain was the lack of loyalty by tech companies. Meanwhile, the mayors of Austin and Miami were saying, we're open for business. We have low taxes. We have a reasonable cost of living. We're not going to burden your startup with undue regulation. And so I think, Wyoming is really at the leader of the pack in terms of states
for sure
embracing a regulatory environment that's good for capital formation and innovation.
And Bart, I'm going to check in. We're about 2 minutes before the top of the hour. I have about 3 questions left. Do you have a hard stop in 2 minutes, or you can go 5 minutes over?
I can go 5 minutes over, and I'll try to keep my answers brief so we can get all 3.
Okay, let's do it. Meant to be a little comical, but true. How high can fees go before users stop interacting with Uniswap and other dApps?
So this is a high-class problem. When so many people are on your blockchain, fees go up. We're talking about gas fees here.
Yes.
And what I think we're going to see is very soon, like in the next 6 to 9 months, we're going to see some layer 2 scaling solutions that are going to alleviate some of the fees that we see on Ethereum that are a result of DeFi, just parabolic growth. So when I see high fees, I see champagne problems. What we do know in crypto is that the pace of innovation is like no other industry on the planet. We're seeing academic breakthroughs at labs at Princeton or MIT or Stanford go from a research paper to a production blockchain environment in under a year. There's incredible innovators, mathematicians, cryptographers, PhDs in distributed systems that are working on these problems in real time. It's not one of the things that keeps me up at night.
If you could hold on to only one cryptocurrency for the next 10 years, what would it be and why?
It's a boring answer, but I'll say Bitcoin. Bitcoin,
safe bet.
Yeah, I mean, it's a store of value. Arguably, hardcore Bitcoiners that tend to have a little libertarian feel. Maybe they've read some Austrian economists, or they don't really like money printing. We haven't seen inflation since the 70s. You couldn't paint a better macroeconomic picture for Bitcoin for the next 10 years. It's no coincidence that global macro investors like Druckenmiller and Paul Tudor Jones are attracted to this. And these guys are not known as technological, tech investors. They just look at the macro environment and they say, I have 2 choices now. It's not just gold. I can own Bitcoin too. With gold, you have an extractive resource that have 5,000 years of history. With crypto, you have some of the smartest people on the planet that are not just voting with their pocketbook, they're voting with their feet. And so it's a boring answer for your viewers, but it would be Bitcoin for the next 10 years.
And the last question, then I'll do about a 90-second close. Do you have any qualms? It's a listener question. Any qualms about major banks being the biggest IP owners of blockchain technologies, not unlike major oil and gas companies owning most of the best green tech, according to her? What do you think about that?
I think IP, intellectual property owned by corporations, is a non-issue. The most important thing to realize in the blockchain and crypto industry is that these are open source software projects. And what we've seen in the technology industry over the last 40 years is that open systems tend to win over closed systems. Look at Microsoft's operating system. It's lost dramatic market share over the last 20 years to Linux. And Linux is at the kernel of the Apple operating system, iOS. And so what's great about open source software is we can crowdsource intellectual capital from around the world. There's hundreds of contributors to Bitcoin cores core software. These are some of the best and brightest cryptographers in the world that are contributing to this. And so when I see Bank of America or JP Morgan owns a bunch of blockchain patents, I just kind of snicker that they're just not really in on the joke. The joke, that they don't realize is that open systems tend to win over closed systems. That's why we're not seeing these enterprise blockchains owned by banks have any traction, because you need to have a native crypto asset associated with an open blockchain. That is the incentive. Blockchains, at the end of the day, elegantly align incentives of their participants. They also have penalties in some cases, and human beings operate by incentives and penalties, carrot and stick. Open systems tend to win over closed systems. You can't patent open software development ecosystems like Bitcoin or like Linux. So I don't worry about banks' IP portfolios at all.
And Bart, in terms of those that are investors and qualified and want to learn more about blockchain capital, how could they learn more and who could they contact at the firm?
So you can go to our website and you can sign up for our public newsletter. Our newsletter is published weekly, and it covers our research teams kind of puts and takes, our analysis on a lot of the news flow and the themes and the developments, whether they be technological or regulatory, new products, new companies. So that's a great way to keep in touch with us. Go to our website, sign up for our newsletter. We're also active on Twitter at BlockchainCap, and I'm at PBartStevens. A lot of the dialogue and the kind of conversations that happen in crypto, they happen in a public forum. They happen on Twitter, crypto Twitter.
For sure.
So, it's important as investors and entrepreneurs ourselves in this industry to not just talk the talk, but to walk the walk. So we believe in transparency over opacity. We share a lot of our research with the public. When we created the world's first security token, we open sourced that offering document that cost us $1 million from those fancy law firms that I referenced earlier. And we try to walk the walk on decentralization rather than being kind of a centralized repository of data that we don't share. And so I'd encourage your viewers to, you can send us an email to investor@blockchaincapital.com. You can go to our website at blockchaincapital.com, and you can follow us on Twitter. Those are 3 great ways to keep in touch with our views on the ever-changing crypto industry.
That's fantastic. Bart, I do a close. It takes about 90 seconds. I want to be respectful of your time. You may feel free to exit. It's been tremendous having you on. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, and I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of wealth investors and their family offices. Go to our website, look into membership. It's incredibly easy. We're an extremely active community, from our proprietary content, thought leadership, our private forums for families, hundreds of video and interviews that we do every year. And although we did one in December of this past year and we're in the midst of COVID, but sometime later this year, physical events will come back as well. There's many benefits that we offer to the kind of people that I noted, and simply going to FamilyOfficeAssociation.com, looking into membership and perhaps joining and being a part would be great. My direct email is angelo@FamilyOfficeAssociation.com. We're also very active on social media, YouTube being one of our most common platforms, although Twitter not so bad as well. And actually, we're kind of the same name on both. We're Family Office. I registered those like 12 years ago, so I got lucky. My little final comment, a reminder, there was some conversation on investing, broadly speaking. This was meant to be at this given time. It's per opinion. It's educational and entertaining. Everyone's situation is different. You need to do your own diligence. You have your own goals, time horizons, risk tolerances, and anything with investing, you could lose. It doesn't always work out. So do your own diligence and always be careful. Everyone, thank you so much. Look forward to the next time. Bart, it's been a pleasure.
Thank you, Angelo.
Thank you.